Wall Street is preparing for another 75 basis point rate hike coming in the next month. Now, a new survey out of Bloomberg is showing economists expect interest rates to hit 5% by March of 2023. Joining us to discuss further, we've got Brian Rehling, Wells Fargo Investment Institute Head of Global Fixed Income Strategy. Good to have you in studio today. Feels like the 75 basis points is largely baked in for next week. The question is what happens come December?
Yeah, that's the big question in the market. And I think it's 50-50 come December, whether they stay with 75 or they downshift to 50. I don't think the Fed's going to commit one way or the other next week. It's really going to come down to that data post-Fed meeting, both the jobs report and most importantly, the inflation data we get around mid-November.
Talk to us a little bit about, we were talking during the break, some concerns about liquidity in the bond market, which I've been following as far as the dollar has gotten higher, has risen, even though it's pulled back a little bit. Other countries perhaps not buying as many U.S. treasuries or selling their treasuries to back their currencies. Exactly. So is this a concern that you're watching?
It is a concern. Both we're seeing, as you mentioned, the impact of other central banks, but also our own central bank doing their quantitative tightening, bringing liquidity out of the market. And it's becoming more and more over time, right? So it takes its toll. But liquidity typically isn't a problem until it is a problem. So, I think the Fed will take the steps necessary to make sure the gears continue to run. So if there is just a complete liquidity drain somewhere, I think we can count on the Fed to step in and make sure things at least function properly. But yes, it is a concern, something we're watching pretty closely. And we've seen it at times in the high yield market. There was a short period of time where deals were having difficulty getting sold, as you mentioned. We've seen it other pockets, other places. But it's nothing at this point that's overly alarming, but there are some things to watch out for there, yes.
What does that suggest in terms of where you think Treasury yields are likely to move? The 10-year yield now below 4%. We've seen a bit of a pullback there. Where do you expect it to go?
Yep. So I expect that we're kind of in a process here over the next month or two as we wait for the Fed to downshift, where rates are probably hitting their highest levels that we're going to see. Have we hit the highs yet? It's hard to say for sure, but I do think we're going to hit them if we haven't already at some point over the next month or two. So I do think this is a time for investors to think about maybe locking in some of these rates for a longer period of time. As eventually we head into a recession, inflation moderates, I think we'll get to a point where rates start coming down. So locking some of those levels in now could be attractive over an intermediate term.
And which treasuries would you say?
The longer term, right? So, we've had a lot of investors. There's been a lot of focus on the short end because there's been so much yield there we haven't seen for a long time. But I would start moving some of that longer, start to buy some 7, 8, 9, 10, maybe even longer maturities just to lock in these rates. Because I do think as we move into a recession, inflation comes down, that these rates will look attractive over, like I said, an intermediate time period.
Thank you so much, Brian Rehling, Wells Fargo Investment Institute Head of Global Fixed Income Strategy. Thanks for joining us.
Yeah, thanks for having me.